86% of a $67 billion market, projected domestic Chinese share of artificial intelligence accelerators by 2030, against a current Nvidia slice of that same market that sits at effectively zero. Those two readings, taken 3 years apart and separated by a sequence of export controls, define the delta this script measures. The metric is domestic Chinese share of China's artificial intelligence accelerator market, data center class hardware, and the two dated readings tell a story the projection number alone does not. Start with the baseline. In 2022, Nvidia held the commanding position in China's data center accelerator market. Domestic Chinese suppliers occupied a marginal slice of new procurement. That word, marginal, had a practical meaning for Chinese hyperscalers at the time. When a large cloud operator in China needed to provision a training cluster, the evaluation was real, but the outcome was largely predictable. The foreign product held the performance lead, the software ecosystem was mature, and the domestic alternatives were present on paper but constrained in yield and software stack depth. The procurement decision reflected that gap. Domestic share was small because the foreign product was genuinely better for the workloads being run, and buyers with a choice made the rational call. The 2022 reading is the baseline from which every subsequent delta is measured, and it was a low one. Then the control sequence began. In October 2022, the first tier of export restrictions blocked the direct sale of leading-edge accelerators to Chinese data centers. That closure targeted the highest performance parts. What it left open was a workaround, products with slightly reduced specifications that fell below the control threshold. Chinese buyers moved to those. Then, in October 2023, the second tier of controls closed that gap. The workaround product was blocked. Buyers moved again to whatever remained beneath the new threshold. Through 2024, further tightening removed the remaining commercially viable substitutes one by one. The sequencing matters in a way the individual dates do not capture on their own. Each control tier was calibrated to the workaround the previous tier had created. The result was not a single sharp cut, but a progressive narrowing, a ratchet that left no stable gray area product for Chinese buyers to settle on across a window of roughly 2 years. A supplier that held the commanding position in China's artificial intelligence accelerator market was reduced to an addressable market of effectively zero for new leading-edge procurement. Zero, not declining. Zero for new deployments. That delta on Nvidia's addressable market is the mechanism behind the domestic share reading in 2025. The 2025 reading, Nvidia at zero for new procurement of leading-edge parts. Huawei's Ascend line, principally the Ascend 910B entering that year, became the primary alternative at scale. Domestic suppliers collectively hold the bulk of new artificial intelligence accelerator deployments in China. The shift from 2022 to 2025 was not primarily a technology story. The domestic product had improved, but the more decisive input was subtraction. Foreign competition was removed from the addressable market before domestic products had to match it node for node. Domestic share grew by subtraction first. The installed base is not zero on the foreign side because existing hardware remains in operation, and gray market inventory reached buyers before enforcement tightened fully. But the new procurement flow is the cleaner reading, and on that measure, the 2025 position is unambiguous. Domestic suppliers hold the field because the field was cleared. The Ascend product roadmap is what converts that procurement-driven share into a forward reading. The domestic capability entering 2024 had real constraints. Analysts documented yield variability at scale and a software stack that required meaningful adaptation work from customers accustomed to Nvidia's ecosystem. Those constraints were real and remain partially present, but the roadmap that sits ahead of 2025 is the variable that gives the Morgan Stanley projection its slope. The 950 PR landing in 2026, followed by the 950 DT in the fourth quarter of that year, then the Ascend 960 in the fourth quarter of 2027, then the Ascend 970 in the fourth quarter of 2028. 4 named nodes, 3 years, each targeting a higher tier of the training and inference workload stack. 4 nodes, 3 years, 4. These dates are not manufacturing confirmations. They are company projections, and the distinction matters to the reading. Yield at scale, software stack maturity, and memory bandwidth are the variables analysts flag most consistently as potential slippage points. The roadmap dates are targets. The actual production ramp cadence is the decisive reading that will either validate or revise the slope. What is notable is not the specific dates but the synchronization. The 4-node cadence runs almost exactly concurrent with the years when the total artificial intelligence accelerator market in China is expanding most rapidly. The roadmap is not a catch-up story that starts after the market has formed. It is a convergence schedule that runs alongside the market's fastest growth years. The trajectory and the product sequence are phase-aligned. The enabling layer is not lithographic parity with the leading Taiwanese foundry. Semiconductor Manufacturing International's 7-nanometer class process and advanced packaging techniques are the foundation, and the roadmap does not require matching the Taiwanese foundry at the 3-nanometer node. It requires being good enough at scale for Chinese buyers who face no legal alternative. That is a meaningfully lower bar than winning an open global benchmark, and the distinction between those two bars is what the raw projection number does not make explicit. Think of a water table. Block enough of the competing inflow and you do not drain the aquifer. You stop the external recharge and the domestic recharge rate sets the new level. The export control was the removal of the competing pipe, not a drain on the domestic supply. That is the mechanism behind the 2022 to 2025 delta, and it is the mechanism the projection assumes will continue to operate through 2030. Return to the headline arc. From a marginal domestic share in 2022 to a projected 86% of a $67 billion market by 2030, per Morgan Stanley. The total market figure matters as much as the share figure. The absolute size of the market being competed for has grown sharply even as the foreign competitor has been removed. Domestic suppliers face less foreign competition for a larger total pool. Restricted import demand and accelerated domestic infrastructure investment are not offsetting forces in this case. Chinese hyperscalers and state-linked data centers are expanding their artificial intelligence infrastructure at the same time that the only credible foreign supplier for leading-edge parts has been removed from the procurement menu. The prize for holding domestic share has grown larger at the same time the competition for that share has been legislated away. 86% of $67 billion is roughly the scale of an entire year's revenue for one of the world's largest chip makers, compressed into a single country's artificial intelligence accelerator procurement in a single year. That is a structural reallocation of where the margin in artificial intelligence silicon lands, not a rounding error on the global chip market. 3 interpretations are visible in the readings. The first, the 86% figure, is not a ceiling shaped by ambition. It is a floor shaped by procurement policy. Domestic suppliers do not need to win on pure performance to win the contract. They need to be the option that is legally available. The competitive field was narrowed by the control before the domestic product had to compete on its own terms. The projection assumes that floor does not erode, and the export control architecture gives that assumption structural support. The second interpretation, the delta between 2022 and 2025, is a procurement story. The technology story begins in 2026, when the 950DT and 960 meet production-scale training workloads that currently run on A100 class hardware. That is when the metric shifts from domestic by default to domestic by performance. The 86% projection assumes both phases, the procurement phase already completed and the performance phase beginning in 2026. The projection is not a bet on a catch-up that has not started. It is a reading of a slope already in motion, extended through a product cadence that is already named. The third interpretation is where the raw numbers go quiet. The export control was designed as a restriction. Its measurable effect, traced through the 2022 to 2025 procurement shift, was to define the competitive landscape of a market that will be valued at $67 billion by 2030. The instrument intended to hold domestic share at a low reading became the single largest input to the slope that produced a high one. The wall did not freeze the number. It taught the curve which direction to bend. Now the error bars. The 86% figure is a Morgan Stanley forecast, not a measured outcome. At this time horizon, the total market size is sensitive to China's overall artificial intelligence adoption rate, global chip market cycles, and the execution of the Ascend roadmap. The $67 billion total is also sensitive to the definition of the product category. If inference at edge, automotive, and consumer hardware are included alongside data center class parts, both the total and the domestic share arithmetic shift. The Morgan Stanley figure appears to target data center class hardware. The domestic share reading in 2025 is based on export control enforcement and reported procurement patterns, not a direct audit of installed base. Gray market inventory means the foreign installed base is not zero. The new procurement flow is the cleaner signal. On the Ascend roadmap, yield and software stack variables could push production ramps later than the named dates. Taken together, these error bars change the magnitude of the terminal reading, not its direction. The 2022 to 2025 move from marginal to dominant by procurement is documented. The question is where the terminal point lands, not whether the slope is real. The metric ran from negligible domestic share in 2022 to a projected 86% in 2030, and the steepest portion of that move is bracketed exactly by the years of heaviest restriction. The control moved the curve it was designed to freeze. The first real test of whether the trajectory holds is in 2026 and 2027, when the 950DT and 960 meet production workloads at scale. The performance data that emerges from Chinese hyperscalers in those years is the next dated reading. Will the gap to A100 class hardware narrow enough to confirm the 86% slope, or will yield and software constraints push the terminal reading lower? If you want that measurement when it becomes available, subscribe and turn on notifications. That is the reading this channel will take.